concept assembly line where ideas get to work. It usually starts with a pre approval letter. You walk into a bank or open an app. You fill in some forms, provide your income, maybe a few pay stubs. They pull your credit score. And then click, you're approved. Hundreds of thousands of dollars now exist with your name on it, digitally created in a heartbeat. No gold bars, no vaults. Just a promise made real by a keystroke. What most people don't realize is that this is how most money is made in the modern world. And this, more than zoning laws, foreign investors, or even interest rates, is why home prices keep rising. Not just in Manhattan or San Francisco, but in Columbus, Boise, and Tampa too. Because when banks create money through mortgage lending, they're doing more than helping people buy homes. They're inflating the very value of the homes themselves. Let's explore the hidden engine of housing inflation. Here's the trick. Money doesn't only come from the government. Most of the money in circulation is created when banks issue loans. It's a little counterintuitive. You'd think loans come from savings, like water poured from a jug. But in reality, banks don't lend out deposits. They create new deposits every time they approve a loan. That $400,000 mortgage you just got? That wasn't someone else's money. It didn't exist until you applied. The bank typed it into existence, just like all government spending is created fresh by the spending, not financed by tax dollars. This process is called credit creation, and it's the beating heart of our economy. It's also why your neighbor's house, which sold for $230,000 5 years ago, is now going for $395,000. Homes don't multiply on command. Money can be created in an instant. Houses can't. You can expand the money supply with the flick of the loan officer's wrist, but building a home takes time. Zoning permits, construction labor, materials, months of work. Supply is slow and sticky. Demand, however, is fast, especially when banks are happy to lend. So when mortgage money floods a housing market with limited inventory, you get what economists call asset inflation, though the rest of us just call it a bidding war. It plays out predictably. More buyers show up with more mortgage-backed money. Sellers raise prices. Banks respond by approving larger loans, justified by the new market value. Everyone borrows more. And prices rise again. This isn't some isolated problem. It's a feedback loop built into the way modern banking works. When credit becomes a housing policy. Imagine if we created money through a different mechanism, say government investment in schools or infrastructure. That money would flow into wages, productivity, or public goods. But we've chosen a system where the bulk of money is created through private loans, and those loans are disproportionately aimed at real estate. This is not necessarily by design, but it is by structure. Banks like mortgages. They're collateralized. They're predictable. They generate decades of interest payments. And they're safe, for the bank at least. So the lion's share of newly created money enters the economy not to build factories or fund clean energy or raise teacher salaries, but to bid on existing homes. Let's explore how your loan is someone else's housing problem. Here's the part that stings. Every mortgage inflates the price of not just your home, but every similar home on your block. That's because housing is priced on comparables. Your overbid becomes the next seller's baseline. And while you're celebrating your purchase, someone else is getting priced out. Someone with the same income you had 5 years ago, but with higher prices to contend with now. It's a quiet form of generational inequality, a system that rewards early borrowers but punishes those who come later. So what can be done? That's the question we're still afraid to ask. Because it would require rethinking not just housing policy, but monetary policy itself. It would mean asking, should the main way we create money be through debt? Should housing be the asset we attach that debt to? Is there a more productive, less extractive way to fund our economy? These are big questions. They don't fit on bumper stickers or in 30-second ads. But until we grapple with them, we'll keep repeating the same cycle. Credit expands, prices rise, affordability shrinks, and people wonder why it keeps getting harder to buy a place to live. So how might we go about rebalancing the machine? There is another way forward, one that doesn't require waiting for the housing market to collapse before we act. Rather than relying so heavily on private banks to decide how and where money enters the economy, industrial policy can serve as a parallel and more purposeful engine. One that channels money creation into public goods, innovation, and broad-based prosperity. Think of it as a counterweight. If the mortgage system is gravity, industrial policy is lift. The mechanics aren't theoretical, they're tested. Let's consider the Bank of North Dakota, a better model hiding in plain sight. In the wide-open plains of one of America's most politically conservative states sits one of the country's most quietly radical institutions, the Bank of North Dakota. Created in 1919 by farmers who were being gouged by distant lenders and rail monopolies, the bank was a populist rebellion against financial extraction. Instead of watching capital flow out of the state, they built an institution that circulated back in. The Bank of North Dakota is publicly owned. It doesn't compete with local banks, it partners with them. It supplies liquidity, shares risk, and lends into places private banks might avoid: student loans, small towns infrastructure, affordable housing. It makes a profit too, profits that are returned to the state's general fund. During the 2008 crisis, while Wall Street banks were hoarding cash or collapsing, North Dakota kept lending. It fared better than almost every other state, thanks in part to a century-old institution rooted in community resilience. And here's the twist. It's worked for over 100 years in a deep red state that often scorns big government. But the Bank of North Dakota is popular not because it's ideological, but because it's practical. It doesn't stifle private business. It shores it up. It's a living example of how public banking can coexist with and even improve a capitalist economy. What if we started over? We rarely talk about the other side of the debt ledger, the part where the numbers don't go up, where borrowers fall behind, and where household balance sheets quietly erode beneath the weight of past promises. Because while mortgage debt inflates housing prices and bank balance sheets, consumer and student debt weigh down the exact people we often hope will drive future economic growth. Young people delaying marriage, families skipping vacations, entrepreneurs shelving their best ideas, not because of interest rates or inflation, but because their monthly payments to legacy debt eat up everything before imagination can begin. So here's a bolder question. What if we cleared the slate? Not all debts. Not without nuance. But enough to restart the engine of productive borrowing. Borrowing that builds, rather than just recycles inflated prices. It's a modern version of an ancient idea, the debt Jubilee. In ancient Mesopotamia, rulers would periodically cancel debts and free debtors from bondage. Not out of benevolence, but necessity. Debt would build up to unsustainable levels, threatening the entire economy. The Jubilee wasn't a handout. It was a reset. Today, of course, we don't have kings declaring jubilees from palace balconies. But we do have central banks, public balance sheets, and monetary mechanisms that could achieve similar ends. A modern debt jubilee could take many forms: targeted cancellation of unsecured consumer debt, forgiveness or refinancing of student loans tied to public service or hardship, or even issuing digital credits to both debtors and non-debtors to maintain fairness. No new Tea Party intended. The Federal Reserve could absorb the cost on its balance sheet, insulating the fiscal budget and avoiding inflationary spillover. Done right, it wouldn't destabilize the system. It would stabilize people. It wouldn't be about charity. It would be about capacity. And crucially, it would rebalance the credit market itself. With less household debt overhang, banks could shift their attention from speculative lending to productive lending. That's how you move from a mortgage-led system to a real economy one. We can't fix housing until we fix money. And we can't fix money until we remember what it's supposed to do. It's not just a medium of exchange. It's a social contract, a shared belief in potential, in future returns, and what people can do when they aren't buried by what they've already done. So yes, reform the banks. Build the public infrastructure. Create new paths for money to enter the economy. But also consider this, that the system we've built is so top-heavy with mortgage debt and household fragility that perhaps the most radical thing we could do isn't build more, it's to forgive. Forgive not to forget, but to make room. Room to dream, to build, to start again. Because that house that credit built, it needs neighbors. It needs shops and schools and factories and ideas. And it needs people free enough to walk through their front doors with more than just debt behind them. Enjoy this video? Like and subscribe to help others find the channel.